Kind of an update. I know it's been a while. I think my last video was 3 months ago, and the reason why I haven't been posting is because I've just been pretty busy. But I actually wanted to make a video on a new trade strategy that I've been doing, but I just have here like a short portfolio update. This is not my actual P&L right now. I'm more so at like 85,000, and the reason why it says 89,000 is just because of the way the platform works. It like takes into account trades that are not yet closed, so the credit I received from opening these trades gets put onto my overall portfolio amount, which is incorrect. But anyways, it's been a pretty decent time since my last video. Stock market essentially went down pretty hard. I held onto my short put positions and kept rolling, defending them until the stock market reversed, which is when I basically was able to take a profit, which is super nice. I was also very long bonds at that moment in time, and to see them reverse was very good for me. So what we have here is my 0 DTE long butterfly trades. So what exactly is a long butterfly? So you can kind of think of it as a straddle, except the wings are defined in the sense that with a straddle, you have unlimited losses on both sides, with the highest amount of profit being straight in the middle. So this way you can kind of protect yourself against huge drawdowns or up moves. The trade ends up being a debit versus a credit, yet it still profits from a decay in volatility. I have on the right side the long butterfly spread example, and this is basically when I started on the day before Halloween. The first mistake I did was I have a set of rules right here, and this is based off of what kind of Tasty Trade laid out.
The good stuff. Okay, so average P&L. Now this is all correct. This is buying in the morning, letting it go to the afternoon. 10, 20, 30, 40, 50, 60, $70 wide. We looked at the wings. And that's just, think of butterfly wings. That's all it is. In high IVR, you did way better than low IVR. And we've always said this.
When the volatility is high, you want to make your spreads a little bit wider. Between 30 to 50 is generally what they go with, depending on IV rank. Here, IV rank for S&P 500 was around 65, which is huge for that ETF. Earlier this year, IVR was like -1 or something like that, something crazy. Okay. Right here, 65, I definitely should have done something like 50 wide. And I was kind of just testing the waters, so that's why I kind of closed early and just got like a scratch. The next one, I started with 50 because I kind of tried to follow the rules. I got burnt, which can happen. I literally lost I hit max loss, essentially. I let the options expire. And then it kind of went downhill, but I really wanted to continue testing this strategy based on the research that I saw. And at least within this week, the strategy has become a lot more profitable. Yet I am still overall down on this strategy, as you can see in this curve right here. I would say after about like 200 to 250 trades, you can kind of get an idea of whether this is going to be a profitable strategy or not. The problem with data is that it's always retrospective. The market is kind of like a living organism. It's always changing based on like current circumstances. So using historical data doesn't necessarily predict with like certainty what is going to happen or what will happen. With that being said, it's just more out of curiosity versus it being actually useful for setting up your trades. But who knows, maybe I might find something interesting in the sense of like closing at 50% of the credit versus letting it expire, or like do my 30 wide spreads make more money than my 50 wide spreads, and so on.
So that brings us to overall, in terms of risk and reward, the $30 wings perform best. But during high volatility, $50 were more profitable because in high volatility, you're going to have bigger daily moves. Typically, tasty mechanics call for widening the strikes when volatility expands. So we never really thought about $50 wide because it's expensive, but that makes the most sense in high volatility. In every other form of volatility, the $30 wings make the most sense. So let's see how a trader who used $30 wings in low volatility and $50 wings in high volatility would compare. Next slide.
Okay.
So what happens here is, and this is strictly $30 wings, nothing else. When you did the $30 wings in low IVR, win percentage was 53, the P&L per day was 81 cents, and your C-bar was $14. Strictly $50 in high implied volatility, your win percentage went up, but you actually made a little less money, you took more risk. So, we put the IVR sensitivity down below, and just to get it into essentially to give you some context around that, and to give you some context around average P&L and C-bar. C-bar is just your outlier risk.
So to set up a 0 DTE butterfly, it's pretty simple. So right here, I'm on the options chain for SPX, which is basically SPY times 10. So think about everything that I do. If you're going to use SPY, everything I do divided by 10, and that's exactly what you should do on SPY if you want to use SPY and have the equivalent of SPX. As you can see, I already have a long butterfly set up. I like to do kind of like a 1 DTE, so I guess I should rename my Excel sheet 1 DTE long butterflies, but I'll set this up kind of like in the afternoon, the day before for 1 DTE, and then tomorrow I'll try to close at 50% of the debit paid. Right here, I basically sold 2 calls. You could do 2 calls or 2 puts. It doesn't actually really matter that much. You're going to be short premium in the center, and then you're going to go 30 wide on both sides. So this is 4380. I go ahead and minus 30, 4350, plus 30, 4410. And so if you kind of look at the curve on what that kind of looks like, this is basically what you have in terms of like your profit and your losses. So here's your max loss of 1,160, your max profit of about like 1840. When you're trying to close at 50% of the debit paid, that's going to be about like $550 or so. Whether you should let them expire versus closing them at 50%, it's hard to say. Tasty Trade's research kind of showed they recommended closing at 50% of the profit, and in another video, they showed expiring. So I actually have no idea. I saw some other videos from other people, but I don't know if I necessarily trust them at the same degree I do with Tasty Trade. And also I tried to do some back testing on this strategy, but for 1 DTE, 0 DTE, it's actually really hard to get the data, and I'm not really sure why. But the whole premise is that SPY moves less than 1% plus or minus a day, and this is basically within that range. So if you're betting that SPY is going to do what it normally does on a day-to-day basis, you should be making profit. And let's imagine it has a huge swing to the downside or upside. Your losses are at least capped on both sides. Now, another thing that you might be thinking is, should I be selling the premium directly in the center where the strike price is, or should I go and have a bias a little bit down or a little bit above the strike price? And that's really up to you. One idea is, if you believe that the market goes up over time, as shown in historical data, and you plan on doing this every day, you could price it so that it's just slightly above the strike price, so that you're accounting for that positive growth over time. Another way you could approach this is you could look at EMA, and you could kind of price your long butterfly wherever your EMA is telling you to basically price. The last final thing is that these SPY long butterfly spreads should really only be around 2% of your overall portfolio. You want to make these trades very small, so that, in my case, I lost like 4 in a row. If I was pricing these with 25% of my portfolio, lights would be out, I'd be dead. By keeping them small, you allow the law of large numbers to kind of like play in your favor, because this is supposed to be a positive EV trade. So Should you be trading long butterflies? Well, it's really up to you. While this has been shown to be a positive EV trade, I wouldn't really scale up on this type of trading in my portfolio because there's no way to really defend or manage this position. Once you put it on, you really can't do anything but sit there and just let the magic happen. Whether you win or you lose, you can't really control that. Whereas if I sold a 30 delta put, for example, at 45 days DTE, I have that option to defend that position if the strike price goes against me. I can roll out in time for credit, or I could sell a call spread against it or a naked call against it. There's a lot of options when you have a lot more time in that sense, but for long butterflies, you really can't do anything but just win or lose. My final thoughts on long butterflies is that it's a good way to engage yourself in the market if you want to be trading every day. It's just that you can't really change your outcome, your probabilities. If you're going to do this, keep it small, trade it often. I would only have like one at a time because the only real way to make money is to have diversification and risk management.
Nice. So you have lower return and the lower risk, a lower standard deviation, but sometimes people really want a higher return, right? How do you satisfy both? You know, higher return and lower risk. Is there a free lunch? So he was thinking, right? So there is actually. So not quite free, but it's the closest thing. You probably heard this phrase many times. The closest thing in investment of free lunch is diversification. Okay. And so he's using a leverage here as well. So, but let me talk about a bit more about diversification. So let's consider two assets, A and B. In year one, A goes up to basically doubles, and year two goes down 50%. So asset B in year one loses 50%, then doubles up 100% in the year two, goes down to 50%, and it goes back up to 100%. So that's when you look at them independently. But what if you had a 50-50 weight of the two assets? So someone is quick on math can tell me what does it change. So you start with 100. You're up to 1.25 at this point. But what it happens in the following year, when you have this move, this comes back 50%, this goes up 100%. You return another 25% positively without volatility. So you have a straight line. You can keep, so if this 2 year is so that's so-called diversification benefit.
Oh my